Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Welcome, Wealth Builders, to episode 10. And I'm not going to lie to you, this is a very special episode. This is going to be really, really interesting. We've got great stuff to talk about. We have joining us today a very special guest, a good friend of mine for many, many years. He is an associate clinical professor at Indiana University and holy moly, works with basically just everybody. I don't even know if I can do it justice. Let me just introduce him and he can tell you more about himself. Let me introduce to you my good friend, Russell Rhoads.
Thank you very much, Dan. I always say when people are speaking nicely about me, I wish my mom was still around to hear that. So yeah, Dan and I have a common background in that we were both instructors at the CBOE Options Institute. There's a really great group of people that were associated with that, with Deb Peters and Jim Bittman and all those guys back in the day. And I've always been very, very honored to be grouped in with all of them. And the great relationship between me and Dan is I replaced Dan. Dan chose to go out on his own and do the great work that he's doing now. And so for a year or so, I was the new Dan Passarelli, but kind of worked my way over to the academic side of things with doing some consulting with some of the exchanges, which makes me pay attention to what's going on in the real world. But at the same time, I teach undergrad derivatives at the Kelley School of Business. And the way that I'm trying to teach it is less quantitative, which matches up with some of the things we're going to talk about today. I feel like the concepts get lost in the math, and Dan's really good at making sure we bring things back to the concepts. And I think that's what we're going to do.
Yeah. And you still work with a lot of exchanges and like everybody, right?
Yeah. The work that we did at CBOE, and this is both of us, was really kind of the class of education among the different exchanges. I think the Options Institute was around a lot longer. CBOE put a lot more resources into it than other entities. And I just think that because of that, we both kind of come out of a place that, you know, that we learn to try and get these concepts across to a wide variety of audiences. And that has led to the way that I go about trying to teach this stuff at the university level, because I mean, both of us would deal with this on a regular basis, where somebody would show up at one of the CBOE classes and, you know, you get to know them a little bit. And they'd say, well, I took this in college and man, did I hate it. And they hated it in college because it basically was a calculus class. And, you know, our job at CBOE was to get people less frightened and more interested in options. And I think both of us are true believers in that if you're actively managing your own portfolio, you need options in your toolbox. And I like the title that you have for this podcast, which is the wealth building part, because everybody thinks of options as trading vehicles. But when properly used, and I would refer to people that are using options, even if you're using weekly calls to increase the income of your portfolio, you really are using them from an investor and not a trading standpoint. And I think that gets lost an awful lot when we talk about the option market.
Yeah, it does. And we've spent a lot of time talking to our audience thus far just about that concept. People get all in a tizzy when they hear options, derivatives. Oh my goodness.
Oh gosh. So yeah, I mean, both of us have been to multiple, type of trade shows, and we would always have somebody wander up to the CBOE table and go, I traded options in 1984 and those market makers ripped me off and I'll never do it again. That generation seems to be falling off.
Yeah. Oh, yeah.
Yeah. And we both have a common friend, Larissa Miller, who is now Larissa Demiak. She's a professor with me at the Kelley School, and we drive back and forth to Bloomington from Chicago together, which means we talk an awful lot. And because you two work together and I work with her now, I talked to her about that I was doing this today. And we just talked about the different generations of folks that have been exposed to options since CBOE launched a little over 50 years ago. You have people that do nothing about them and maybe didn't have the best of experiences. Then you had other folks that knew about them that got brought along. But now, I mean, I'm teaching derivatives. I've got about 30 kids in my class, and 8 of them have Robinhood accounts and are trading options already. So they're getting started earlier. You know, maybe they're paying the lost tuition earlier than a lot of folks do. But how we talk to them is probably a little bit more in depth than how we talk to the earlier generations of option traders, because they do have some understanding of what's going on within the option market and how things should pay off. But yeah, I still get questions from college kids about, why did the stock go up? You know, stock price went up, I owned a call and I lost money on that call. Well, let's talk about implied volatility for a minute. You don't necessarily have to know how to calculate it, but you got to know that when it goes down, option prices are going to go down as well. And you got to have an idea as to when you think it might go down.
And, you know, here where we talk about covered calls and cash secured puts, there's nothing we love more than option prices going down.
Yeah. Pick up the inflated volatility and then, you know, just trying to take advantage of when you think it is typically overpriced. At least from market environment to market environment. We've seen a year where index options were overpriced tremendously, and then the next year they were underpriced tremendously. So, you know, over a long period of time, options are going to be overpriced, but there are periods where they are underpriced. But those tend to, much like the reversion to the mean on VIX, that type of market activity reverts to a mean as well. Benefiting option sellers over option buyers. And, you know, and just to revert to the college kids for just a sec, they're all option buyers. They're all option buyers. And I even had one that yesterday in the class, I demonstrated, and you probably have seen this example because I think I stole it from our old materials, but I basically showed buying a call on an index and the market goes up, but the volatility goes down and you only make about 18 cents off of the option, even though you got the market correct. So if you had sold another call option against it, you would have done much better with the trade. But I did have a kid come up to me after class and had said that he bought calls on something. Market moved in the right direction. He about broke it even, but from here on out, he's going to start doing vertical spreads.
Hey,
yay. So I saved one yesterday, but and I stole the old Marty Kearney line. He always liked to say, if you've got to buy an expensive option, you need to sell an expensive option as well. I know I'm talking about the opposite of what you like to do, but expensive options are out there to take advantage of selling as well.
Okay, so let's talk about how you explain this stuff to undergrads, especially in the context of covered calls, cash secured puts, that kind of thing, but maybe even just options in general, because, you know, you're a professor, but you're also a trader. So you probably have a pretty interesting perspective.
The story that I use on that is I got to learn to say no. And that doesn't apply to this podcast, Dan. I'm thrilled to be here, but I got to learn to say no to things. And I was on a board of education. I was actually elected to it years ago, and there was someone who got elected on the board and ended up sitting next to me who was interested in options. And one day during a meeting, during the public comment section, he just leans over to me and he said, "What do you think about buying the IBM 160 calls?" So we both flipped our microphones off so people couldn't hear us talking. And I said, "You're asking the wrong question. The question, what you should say is, Russell, I know you understand options better than the average person. I think IBM is going from 160 to 180 over the next 3 months. How do I trade that with options?" So what I'm doing when I'm teaching and this class really is, Indiana is a great place that will allow you to do experimental type classes like this, and with a very tight leash. I mean, I had to go for a committee. I had to explain the reasoning behind it, but the thing has not gone 100% smoothly. Every time, the first time you do things, it never goes 100% smoothly. But typically when we teach these things, we may start out talking about buying a call, buying a put, blah, blah, blah. I start out with, every option trade should start with a price outlook and a timing outlook. And then and we'll go through that. Like, I'm a willing seller of, and you know what? Are you aware that a stock now has the ticker XYZ? So we got to come up with a new teaching ticker.
I've done it.
I'm so glad I didn't work at CBOE now because of all the slides I'd have to update. We used to X, so I started to say XYZ. But let's say we own XYZ anyway. It's a fake stock. And we're a happy seller of the stock at 40, and we could sell a 40 strike call for $1. Well, I haven't used any Greeks. I haven't used it. It's just, I'm willing to sell the stock there, and I'm willing to take $1 in to take on that obligation to sell the stock at 40. That's what you need to be thinking about. What you do with respect to selling puts to get into a stock and selling calls to get out of the stock or increase income, it's the same thing. The strikes that you're choosing, they've got to start with what your price outlook is. Or I shouldn't say gotta, but that should have some influence on that. And we're audio only, but I can see Dan right now, and he's getting ready to jump in.
Yeah, I mean, yeah, I'm just trying to think of how I can steal this without. Have you copywritten that what you just said just yet? Yeah, because I kind of love that, where you don't have to actually think about Greeks or implied volatility necessarily if your objective is to trade out of a position.
Yeah, and that's when I'm starting. Yesterday, and I just mentioned that the student was like, I bought a call and didn't make money, and now you showed me, a bull call spread, and I said, I got something even better for you. How about a bull put spread? Everything apart. Yeah, I explained that one after class a little bit, because you got to start with the bull call. Just conceptually, you lose people with the put one there, but that's where we started. Last week was the price and timing outlook. This week was price and timing, and if you're trading, let me talk about implied volatility. And it just basically showed, buying a straddle and getting creamed because implied volatility dropped. In fact, the last half of this class, next week is their options exam. There's 3 exams. Futures is done, options is getting ready to be done, and that just coincides with earnings season. And the last part of this class is nothing but trading earnings season.
Oh, wow.
Here's your outlook. But here's the history. And I know you're terribly interested in earnings as well, but here's what the stock's done. I use that 3 years of history. It's gone up as much as 9%, down as much as 9%. You can flip a coin and decide if you're bullish or bearish and use that price outlook. All right. Tell me what option trade you might do. There's going to be an awful lot of that in the last part of the class. But again, everything's going to start, again, going back to that price and timing outlook. And I'm going to give them a little bit of hints on it, on the price outlook, because that can be you don't teach that in a derivatives class. You're trying to figure out which of all those things I threw at you to talk about.
I mean, honestly, the one that I kind of want to talk about is the earnings one, but that's kind of a little out of the scope of what we talk about here. But yeah, as you know, my other life, wearing a different outfit, I'm definitely an earnings trader when I'm not investing with options, for sure. And
it's fun. One little comment on earnings and we move on. If you've got 2 or 3 stocks that you have a really good handle on, you can do very well trading earnings. I will only focus on the 50 stocks that have the highest option volume from the previous year. That's my universe to keep me a little bit focused. Although when we're in the down part of earnings season, I start deviating and looking at volatile stocks that don't fall within there. So not fully following my rules, but yeah. No, and as far as selling puts and selling calls, earnings season is a great time to do that. So it does relate to the wheel type of trading as well.
Yeah, and let's talk about that for a second. So we've talked so far on this podcast about covered calls. We're about to talk about cash cured puts, which are, I would say basically the same thing. But we talked about implied volatility and the risk premium, basically trying to sell expensive options. And you just mentioned, which we've talked about, setting a target to sell a stock with covered calls. So I guess in your worldview, you wouldn't avoid earnings trading covered calls. You would lean into it a little bit. Tell me about that.
I would lean into it a bit for stocks that I'm very familiar with. Now, you might get mad at me with something I'm about to tell you. So, years ago, ran a back test on, and this should be updated, but ran a back test on consistently doing a weekly covered call on the most active markets. And it works fairly well. Just consistently selling a slightly out of the money call, different, 2% out of the money, at the money, etc. If you eliminate the 4 earnings weeks, it works great. And here's the reason behind it, because you're going to miss out on some of those big moves. And when I say works well, it works better than just buy and hold. If you do it. But we found, and I was at an entity that did not want to discourage trading. I'll just leave it at that. So we did not share those results. But yeah, it's like, this is something, this came up in a conversation recently where I was like, oh yeah, if you avoiding selling calls, if you do a consistent blind covered call strategy. So, and I don't think anybody should do consistent blind strategies. But if you do a consistent blind covered call strategy, and you just, every Friday you sell an at the money call that expires the next Friday, et cetera, you will outperform buy and hold for most stocks over a long period of time, maybe slightly. If you avoid earnings weeks, you will outperform. I mean, it's like 2 or 3% a year more. And it's really because you're out of the stock during earnings weeks. So you don't get hit on those downside that you have to make up, but also you're out of the stock on earnings weeks, but you're not like sacrificing the sweet spot by being short a call against the stock. So you're actually you're out of the whole thing during earnings weeks.
Oh, so okay. So hold on a second.
Yeah. So it's not just holding the stock and avoiding selling the call during earnings week. You actually need to be out of the stock during earnings week.
Oh, that is interesting. So, okay. So if you're doing covered calls consistently, serially, and you'll do well, you'll outperform somewhat.
Yeah.
If you close the call and sell the stock and just get out of that whole thing through earnings, you actually outperform even better.
Yep. And that's because the options are overpriced. The earnings options are overpriced about 2/3 of the time, like normal. But the times that they're not, they just get completely run over. Options are overpriced about 2/3 of the times as well on non-earnings weeks, but you don't get run over.
Yeah.
You're getting smaller premiums. And this is another thing that I kind of found. If you're selling index options as well, you tend to do better when the premiums are lower. Because when the premiums are higher, they're higher for a reason. So I've got a huge database of all of that. Now that we've got 2 years of data, I can work with it. So covered calls are great. The weekly covered calls are awesome, but just some of the hiccups that you experience during earnings season. And as I sit here, I need to write a note to myself. What's it like if you if you just get out of a stock during earnings week?
Yeah. Yeah.
How much of it's coming from the option? How much of it's coming from the stock? I know a lot of it's coming from the options. So I have not run that with cash secured puts, but that might be an interesting, I only did it with covered calls. And then when we figured out that it was telling people when not to trade, we just kind of sat on it.
Interesting. Yeah. I wonder what that would be like with cash secured puts because of the put skew.
Well, I got 30 undergrads that might get put on this.
Ooh, fun. So interesting question. The organization that you worked with who discouraged you mentioning this, I mean, why would they discourage it?
Well, beyond that, it was also a regulated place that you're not supposed to say things that can come across as recommendations.
Oh, fair point.
So I think there's some of that as well. I need to pick this thing back up and put it into a paper.
Yeah.
So, but I was just, because I knew I was talking to you and I knew covered calls were a big deal. I was like, what have I done on covered calls? And I went back and I was like, oh yeah. And I haven't talked about that much. That's just one of those things we ran. It's interesting. I always mention in conversations about covered calls, but I've never really put anything publicly out about it.
Well, if you rate that paper, Let me know.
Yeah, I think Professor Ademiak needs to write that paper. I've got a list. Like I said, I got to start saying no, but never to you.
Yeah. Now, okay, so you said something interesting a second ago.
Uh-huh.
So selling covered calls when the premiums are lower can tend to work out better. Is that universally lower, or are you an advocate of doing the comparison of where implied volatility is versus where it arguably should be? Or what does that whole thing, lower premiums, look like? Or lower vol?
Comparing it to where implied volatility is during non-earnings week.
Mm-hmm.
The differences are not dramatic. And the differences are usually more influenced by what's going on in the overall market than what's going on in the individual stocks, unless there's some sort of a news item that maybe is hanging over it beyond some other known unknown that's hanging over it like that.
Yeah, interesting. Do you think that people should, if they're trading covered calls, that they should do a volatility analysis, and that should be a big part of their decision whether or not to sell the call?
I think they should have an idea of when the options are expensive and cheap, and implied volatility is the thing that's going to give you that measure. You know, we love to talk about tough math, et cetera. I mean, you can just take a look at what's the at the money straddle pricing Friday afternoon, for the next Friday as a percentage. And that's easier to track than implied volatility measures.
Mm-hmm.
And there's a 1-day VIX now but I actually think that using the at the money straddle as a percentage of SPX is just as good, if not a better measure of what people are expecting the next day. And I've started using that data as like a market indicator, not just, much like we use VIX as a market indicator as well. I probably ought to take a look at that versus this is what happens when I do things like this. I come up with, I got to say no to myself. I come up with things to take a look at, but looking at the relationship, we always look at VIX versus the 90-day VIX and some other things like that. And I wonder if looking at the at the money straddle as a percentage of SPX versus VIX, if there's any information in there, if they're moving in opposite directions or anything, if there's anything to pick up there. There might be. But again, for selling call options against individual stocks, if you're trying to come up with a database to figure out when they're expensive and cheap, I actually think there's a lot of work involved in this, but I actually think, what's the at the money straddle each week on Friday, and then where did it finish the following week? That could be doable. And that's doable. My undergrads, they're going to have so much work to do in April. It's ridiculous.
Okay, so two things. So looking at the money straddle, and for folks who are not familiar with kind of what we're talking about, well, I mean, a very basic way to look at it is if you assume that implied volatility, and we're going to use that word assume and talk about that in a second. If you assume that implied volatility is the market's estimate of future volatility, and therefore options are priced fairly or accurately, then what do you use that straddle information for? Is that to set the strike prices, or?
I've used it to set the strike prices on iron condor type strategies. But I've only done that in the index option markets. So I'll backtrack a little bit on this. Back when we were at CBOE, I was running consistent iron condor strategies, just really to see what the pricing was of weekly options. And I was doing this with the weekly PM settled options. And I figured out that if you consistently sold 2% up, 2% down, and then went out 10 points, that you would do fairly well. And I figured this out for SPX. It actually works better for the NASDAQ's options using the NASDAQ volatility index. I jumped ahead a little bit there. So I did both of those, and they worked fairly well. And then I took VIX, and you know how you can convert VIX to a 5-day move? I would take VIX and convert it to a 5-day move and use that to choose the strikes. And that was like, the golden ticket as far as a consistent strategy. And I continue to trade it with NDX using VXN, the NASDAQ Volatility Index, where it chooses the strikes. It widens out or narrows in based on what's going on in the markets. So having the market dictate my strikes with a volatility index, I did that in the index space. I've done that similarly in the equity space, where I use the at the money straddle. And then let's say a stock's trading at 100 and the at the money calls $5 and the at the money puts $5. That's $10. That's a 10% move. End of story right there between now and expiration. So about 2/3 chance the market's kind of expecting us to fall within there. Back of the envelope type stuff, et cetera. And I know that there are professional option traders that are probably cringing, but you got to understand different levels of different option traders really don't need to get that far in the weeds with the numbers. And if that piece of information, which is forward looking, helps you out, then you're in great shape. So if I were doing a consistent covered call strategy and I really didn't want the stock called away from me, I basically would use that percentage and sell that far out of the money call each week.
Oh boy. Okay. I have two divergent thoughts. Hold on a second.
Yeah. Okay.
So first, and this is a little bit of a rabbit hole here, but I think our more experienced folks listening are going to appreciate this one. I wonder if that strategy works setting the short strikes for an iron condor on the S&P 500, whatever you use. I wonder if
I do it on SPX and NASDAQ.
Oh, SPX and NASDAQ. Okay.
Yeah.
So I wonder if it works better on SPX when you use the VIX, because I figure the VIX is overpriced from what it should be, because it takes into account all of that downside put skew that's very, very high.
You get a wider spread with VIX than you do using the straddle.
Yeah.
You definitely get a wider spread using VIX than using the straddle. The straddle will give you a smaller 5-day move, 1-day move, etc. I just wonder, and I haven't run the numbers yet, but you got to assume that there are going to be days that the at the money straddle is pricing more than what VIX would be, say, if you converted VIX to a single day. I know, and you and I are familiar with the rule of 16, where and for people who are not, if you take implied volatility and you divide it by 16, that is roughly a 1-day move. So recently we had a day, and it's when a lot of market volatility was going on recently. We had a day where the at the money SPX straddle was pricing in about a 1.5% move. Well, in VIX terms, that would be about a 24 VIX, and I think VIX was around 20 or so. So they did have a divergent opinion there. Really, this is something that is formulating in my brain as we talk. It's not something I've done work on yet, but I bet there is some sort of information in there. Like if you only sell a straddle when the straddle is underpriced relative to VIX or vice versa. I've been trying to improve on 1-day option trading strategies and trying to come up with some sort of screens, and I just haven't found anything that improves taking advantage of the mispricing of short-dated options.
Maybe you can explain to our folks here, which, I mean, we've kind of been talking about this already, but how exactly does the straddle relate to implied volatility? And is there some math involved there, or what's that relationship like?
Well, the at the money straddle, and when we say at the money, we just mean the strike price that is closest. So there's gonna be some intrinsic value in the option, but let's just say 98% of the premium is time value or something like that. The biggest influence on the at the money straddle's pricing is the time value of options, which in time value of options, there's two things that come into play there. How much volatility do we expect and how much time's left? Well, I'm looking at 1-day implied volatility, and the implied volatility is going to be based on what's the market's estimation of a 1-day, 1 standard deviation move the next day. And that at the money straddle, because that is where, and this is one of the reasons I like the at the money straddle better than the 1-day VIX. The at the money straddle is where all the volume is. And I feel like the less liquid a market is, the more likely it is to misprice things. And for VIX, you do have out of the money, less liquid options feeding into the calculation. And, the original VIX was basically just a couple of at-the-money straddles.
Mm-hmm.
It was only 8 options that went into it, way, 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 way back in the day. That's how it relates to implied volatility. That straddle is going to go up and down in price, really based on the volatility outlook for the next day. And if you've got an SPX at-the-money straddle and a week, I don't know when you're going to put this out, but right now we're speaking on Thursday, March 28th. A week from Friday is an employment day. The SPX at-the-money straddle on the close Thursday is going to be priced higher than where it's going to be priced today on the close.
Mm-hmm, mm-hmm.
I know your focus is equities, but you see it in the Russell 2000 NASDAQ and the European one-day options as well. It's just kind of fun to see how they adjust based on the known unknowns that are facing us down and which ones they seem to care more about. I can tell you right now that the adjustment in front of inflation numbers is not what it was a year ago. The market's not as concerned about inflation. Starting to see that come down a little bit. More concerned about growth type things. So you use the option price to interpret that as well.
I'm a little hung up on vol and straddles here for a second. So would the idea with straddles versus implied volatility be the break evens for a straddle should coincide with the implied move of implied volatility? Is that basically the idea?
You would think that they would, but they don't. Let's think of the one-day straddle as a projection of implied volatility. Or, we can just use the one-day VIX. The one-day VIX is usually at a lower level than the 30-day VIX. So when you're converting the traditional 30-day VIX to a one-day move, there are 29 other days of information in there. And really the reason that I used to use VIX to choose the strikes was because we didn't have an alternative.
Yeah.
And VIX is a great tool for analysis because we've got 30 plus years of consistent implied volatility data that is based on S&P 500 option pricing. And I've only got a couple of years of at-the-money straddles right now to work with. But without having run the numbers yet, and I've got a really cool macro that all I have to do is put a few things in and it can run the numbers, I will almost guarantee that 85% of the time, the at-the-money straddle is pricing lower price moves than VIX. And that's just because I monitor those numbers from week to week and I put them into a Substack. And typically the at-the-money straddle for SPX is priced between 0.6% and maybe 1.5%, but usually at the lower end of that. So if you take 0.6%, that's a VIX of 10.
Wow.
So that if VIX gets back down to those levels, then maybe that relationship will flip. But if the VIX is above 16 and the at-the-money straddle is consistently priced under 1%, that at-the-money straddle is priced less than VIX. I'm going to run both of them side by side. I'm going to start out with selling at-the-money straddles using both, or iron condors using both of them. And then I'll actually do iron butterflies where the implied move by both of those is where I buy the strikes. And again, it's something that widens out and narrows based on market expectations. The day before, the day after Thanksgiving, you're not selling an iron condor that's 2% out of the money in both directions.
Yeah, right.
That's when guys are reading the paper on the floor all day and nobody's trading.
Yeah. Okay, so all of this leads up to me, the big question. So the context that we're talking about using volatility in is basically the old, you read in a textbook or whatever, implied volatility is the market's expectation of future volatility. So if I set my strikes there, boom, that's accurate. But we talked earlier about the idea that implied volatility is not necessarily accurate. So doesn't that just throw a whole fly in the ointment?
But it's typically overpriced.
Right.
Yeah. Which for what you're doing for the consistent option selling strategies. And then also, going back to what I was saying about the kid buying a call option and not being happy about how it worked. It's because over a long period of times, option sellers do better than option buyers. Now, that doesn't mean that there are not periods where it flips around. My thing is with the at-the-money straddle, it really is just a pure look into the following day. But what seems to have been happening with that, and I think it's because of the issuance of structured products, but what has been happening with that is the at the money straddle pricing has been underpriced a bit more than it was when daily options first got introduced. And I really think that's because there are funds out there that sell those options every freaking day.
Yeah, yeah.
And that's put a little bit of pressure on the price projection from day to day.
Yep. That's how I typically describe implied volatility is it's the supply and demand component of an options price.
It is. How aggressively are people buying those options or selling them?
Mm-hmm. Now, you mentioned structured products, and as far as getting into the weeds with that, it's probably out of the scope of what we do here. But we were talking before we started here, and you mentioned an interesting thing about an angle that some of the European brokers are taking when they're talking about option selling. Can you tell us about that?
Yeah. So you and I were heavily involved in kind of I don't want to say renaissance because it wasn't a renewal, but the emergence of options being considered a tool that everybody can use within the markets. Going from a speculative tool that a bunch of guys in Chicago were flipping around to, we have a common acquaintance who's in his 80s who sells RUD options every single day. Dr. T down at Oklahoma State.
Oh, yeah.
Yeah. So, I mean, he's still doing that. And that's the kind of stuff that we've witnessed happen here is just that the overall uses of options has just come into the mainstream is what I was trying to say with respect to that. That's not where they're at in Europe. They're trying to catch up with us. And I did a whole panel for the Eurex exchange on the issues that they have to deal with. They have different tax situations from country to country, even though it's in the EU. There are lots of hurdles there, but it's getting better. And one of the ways one of the brokerage firms is getting individuals involved in options is they refer to structured products. And structured products are much more popular in other parts of the world than the United States. And at a very high level, if you were coming into 2025 and you felt like the stock market's not going to go up any more than 10% this year, you think we might get a massive sell-off, you're able to enter into an ETF that will give you 10% upside and then maybe guard between 5 and 15% downside. And they sell these things as ETFs, which maybe you're not overly bullish, make an awful lot of sense. Well, one of the people on the retail panel, he said that they encourage people to trade options because that allows you to become the issuer of the structured product. You can create your own structured outcome. You don't have to pay somebody a percent to do it. And you can create, you can sell a put spread and maybe buy an out of the money call and have some sort of a structured outcome based on an individual outlook. And this circles back to trading options based on a price and a timing outlook. Going into 2025, not overly bullish, and I was not overly bullish. I actually feel like we're going to have a correction before the year's over with. So people that want to have stock market exposure, I was encouraging them to look at buffer solutions or create a buffer solution themselves or collar their portfolio, et cetera. I liked the way he said it, and he was much more articulate than I was, but you like buying structured products. Why don't you become an issuer of a structured product and create the one that you want to create? Somebody's going to take the other side of it because that's what happens in the markets.
Oh, man, I love that. I love that.
Yeah, I just like thinking of it that way.
Yeah, yeah.
Good book title.
Yeah.
You can have it. Okay.
I already got one.
I'm done with that.
And okay, you said the words buffer protection, and let's just kind of, you talked to the point already, but let's recap. What do you mean exactly by buffer protection?
Well, let's say that you own the SPY ETF and you sell a 10% out of the money call and buy a 5% out of the money put against that portfolio. You've kind of collared that portfolio. Well, you have created a structured outcome. Let's assume when you do the trade, you take in $2 because you can sell the call a bit more than what you purchased the put for. Well, you've added to your returns by taking that in. You've limited your downside to 5%, but you've limited your upside to 10%. So you have come up with a structured outcome. If you've got a strategy that's put in place with options where you know what your loss and what your gain is, that's a structured outcome. If you think about it, buying a call option is a structured outcome. You pay $2 for a call option. The most you can lose is $2. The most you can gain is unlimited. And it's defined when you put the trade on.
All right. I think maybe we have time for one more topic. And boy, you know, we've kept things on this podcast so far pretty basic. We're taking a linear approach here from getting started with options all the way to highly advanced stuff. But hey, you know what? We got you here. So we've talked about VIX and what that is, basically the expected 30-day implied volatility of XPX. You do some work with VIX term structure. Why don't you describe VIX term structure and talk about what you've observed in it and what those implications are?
I'm a big proponent of using VIX. I haven't talked about trading VIX at all. All I've talked about is using VIX to help us with trading the underlying equity markets. And one of the things that you can do is you can take a look at VIX and you take a look at VIX's price behavior versus the S&P 500. For instance, right now, again, it's midday Thursday, March 28th, stock market's down a little over 1%, and VIX is up by almost 2 points. That's what you would expect. If the market were down and VIX were down, that could be taken as, you know, market participants aren't panicked over this 1+% drop today. The demand for SPX puts has not increased because really that's what VIX is telling you, is how aggressively people are buying protection on their portfolio. So you can use VIX relative to SPX like that. But you also want to take a look at what the VIX futures pricing is doing. And that's the term structure of VIX, where you look at the spot VIX. And right now we have expirations, monthly expirations from April to December of 2025. And in a normal market environment, when VIX is maybe in the mid-teens or so, as you go farther out on the curve, on the term structure, the different VIX futures pricing moves up. And it really moves up, indicating a higher risk premium over a longer period of time. You would sort of expect that. Normally, we're in something referred to as contango. Now, when VIX spikes up, it typically comes down very quickly. And today, we're actually seeing a little of this. As I sit here, VIX is at 20.5, and the front month VIX future is at 20. So the front month VIX future is anticipating that VIX is going to move slightly lower between now and expiration. That you can take it that way. But all of the VIX futures are lower than spot VIX right now, but they're all also within about a 40-cent range. We don't have a really flat term structure very often, where you're not getting much of a directional outlook. Whether, you know, VIX is low, but we're in contango, it's VIX is at a normal level, but the futures are braced in case we get a spike. When VIX moves up, the futures might be at a significant discount, and they're indicating that the expectation is that we expect VIX to come back down. When the term structure is flat like this, I think it means the market's pretty clueless as to where we're going. Historically, that has resulted in excess market volatility and typically downside volatility. And typically, the difference between the far-dated VIX future and the near-dated is 1, 2, or 3 points. Right now, it's 20 cents.
Wow.
And it's been flat like this for weeks. I've never seen it flat for this long. I've got all the data to run it, and I've run it in the past. But I got to put pen to paper and run that again. VIX is basically telling us right now, if you listen to 5 strategists about what they think about the last 9 months of 2025, you're going to get 5 very different opinions. I think that's what you're quantitatively seeing from VIX as well, is just a ridiculous amount of uncertainty and probably excess volatility over the course of this year.
Wow. Interesting.
I've never seen it this flat. Just looking at I'm like, oh my goodness.
Well, Russell, thank you so much for sharing your knowledge with us, and especially for sharing your time with us. And
no problem at all.
especially for not saying no.
Oh, I'll never say no to CBOE alumni. Yeah. Anytime you want me to do this, I am more than happy to join you. I can talk about this stuff till I'm blue in the face. You know that.
Well, we'd sure love to have you back in the future. That's for sure. And that about wraps it up for the show. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. And please leave a review. When you subscribe, you'll be the first to hear episode 11, Cash Secured Puts, the brother from another mother. See you then, and in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.